want to talk about a reverse mortgage because I think it's an important piece that people can use as part of their retirement. So I just want to give you some real basics. I want you to talk to your loan originator about it, but the first thing is I want to dispel some of the myths around a reverse mortgage. No, the bank or lender does not own your home. Okay, the bank and lender does not want to take your home from you. Okay, doing a reverse mortgage doesn't mean you give your home to the bank. So let's talk about that. Or you're going to lose your home, or when you run out of money on it, you're going to lose that home. That's not going to happen. So let's put all those things aside and let's talk about some of the little basics on it. Okay? So first, for a reverse mortgage, you need to have one of the spouses be age 62 or older. Okay? So 62, age 62. Okay? You need to have that. You need to have a certain portion of equity in a home based on the youngest spouse's age. Okay? So on the youngest spouse, age. Okay? And the equity. The equity in the home. Okay? So if your home is paid off, you're not going to have an issue with that. If you have a current mortgage in your house, and you know, one of the things we're talking about refinancing, but you can do a reverse mortgage to purchase the home if you have a large down payment. And that down payment is going to be based on the age of the youngest spouse. So that's going to determine the equity, whether you need to have 50% or 60%, whatever it's going to be based on that age. So you need to talk to your loan originator to run you a scenario based on age. Okay, so that's the first thing you're going to look at. The other thing is whether you live to be 150 years old, 120 years old, and the house is upside down, you owe more money, they can't take away your house as long as you live there and keep it as your primary resident. Okay, so they're not going to take away your house. So just know that for starters. That's the basic. So let's talk about a couple other things on our reverse mortgage. One of the first things you need to do is you want to ask and inquire about the age and the equity you have. We talked about that. And before you can proceed, okay, with the reverse mortgage, everybody needs to take a credit counseling class. Okay? It's to learn about the reverse mortgage, how to survive in your house, and how to make sure that you're maintaining your house and that you pay your taxes and insurance. So we're going to talk about that. So you need to do your credit counseling. You need to get that certificate. So there's a lot of certified HUD counselors you can talk to. The reverse mortgage is an FHA HUD loan. Okay? Okay, that's the type of loan. Okay? You need to do credit counseling. Okay? You need to do your credit counseling and you need to get that certificate before anybody can do anything. They can run a scenario for you to give you a basic idea of cost, and you want to do that so you can have your credit counseling certificate. It's going to differ in each state. Some states will require you before they can even run a scenario for you that you do the credit counseling first. So talk to the loan originator that you're working with in your state to make sure you follow the right procedure, because you don't want to screw this thing up. Okay? The loan originator is going to give you the best advice to make sure it's done right, and make sure the loan originator has experience doing reverse mortgages. Okay, it's a great tool. It's a great retirement tool if used properly. Okay, so get your credit counseling certificate. They're gonna do a little scare tactics on you that you're gonna lose your home. We're gonna talk about that in a second. So you want to get that done. So let's talk about the ways on a reverse mortgage that you can lose your home, and I'm gonna put them up here, and hopefully I get them all. They're okay. So one, you have to pay your property taxes. Okay. Property taxes. 2, insurance, your homeowner's insurance. You have to maintain your insurance on the home. Okay, property taxes, homeowner's insurance. If you have an HOA, you got to pay your HOA fees. If you're in an HOA, it might not apply to everybody if you don't have it. Okay. 4, you have to maintain the home. Okay. That means you can't have holes in the roof can't be leaking, you can't have broken windows, the doors. You gotta maintain, if you're gonna have heat in your home, you gotta be able to maintain it, okay? So we wanna make sure you have those things, okay? The most important one, okay, is it's a primary residence. If you move out of the home, it's no longer your primary residence, the note is going to be called. Okay, so if you move out, you have 6 months to sell the home or refinance it out into a standard mortgage. Okay, so it has to be your primary residence. You have to live there. Okay, you can have a second home elsewhere that you visit from time to time, but it has to be your primary residence where you spend most of your time. Okay. Now, so keep it in primary residence. Now, if you have a spouse that passes away, that's okay. No, it's not okay that they passed away, but you still maintain that home. Okay. You still want to do it. It's still your home. If one goes into one of the spouses goes into a nursing home, that's okay because the other one still lives there. It's still their primary resident. You're not going to lose your home. Okay. So as long as you maintain these main features, you'll be fine. Now there's a couple little other quirky things, like if you have work done on a house and you don't pay the contractor that worked on your house, a licensed contractor, that licensed contractor can place a mechanic's lien on your house, and depending on the state, may be able to cause foreclosure. So you want to watch that as well, but these are the main features of the ways you can lose a house. There's no other way you could really lose that home. Okay, so talk to your loan originator. You'll get a booklet on reverse mortgages. It'll have all the facts. The credit counselor will get in more detail about this. Remember, this is just the basics, and it gets started. So let's talk about, some of the other components of the reverse mortgage and what makes it up. Okay, so we're going to look at on a reverse mortgage. Reverse mortgage breaks down into a couple parts. Okay, you're going to have a first mortgage on a home, so we'll call it the first mortgage. Okay, you're going to have a second part. It's a second mortgage. It works similar, okay, similar to a HELOC, a home equity line of credit. Okay, so you have the first mortgage. The second mortgage pays the first mortgage. It uses the equity in the home to pay that first mortgage. Now, in a reverse mortgage, you have many different options. There are 8, 10, 12 options depending on the lender, but there's some real basic ones in there and different options on how the interest rate and everything works. So I'm not going to get real big into those components of it. I want you to talk to your loan originator, which best fits you. But basically, the two main options is a fixed rate component, the fixed rate interest rate in the reverse mortgage. Okay, that's great. Some people are really locked in and fixed on that. But if you go with an adjustable rate, okay, an adjustable rate mortgage in that product, if you use the adjustable rate here, you get a third component of the reverse mortgage, and that's a credit line. I like the credit line feature on that, because this credit line builds. You'll have a schedule of how it builds and grows for you. So the first year, if you're doing a refinance, you can take cash out. If you own the property outright and you do the reverse mortgage, you can use that money for whatever you want. If you want to go on a cruise, you want to pay medical bills, you want to do home improvements, you want to put in a swimming pool, you want to go to Vegas, that money is to do what you want to do. Okay? So you'll get money out the first year, and then the basic component, if you have adjustable rate, you can have a credit line. So maybe 2 or 3 years down the road, that credit line goes to a certain dollar amount. You can take that out all in whole or a portion of that. So the adjustable rate feature gives you the credit line. The fixed rate does not. The fixed rate only goes to here. The adjustable rate has all these components. Okay? So that's the basic makeup of the reverse mortgage. So again, I want to show you some parts. The reverse mortgage, okay, can be a costly loan. Okay, the reverse mortgage has high closing cost. You have an upfront mortgage insurance, so upfront funding fee, okay, mortgage insurance, and that's higher than a standard FHA loan. Okay, that's added on top of your loan. You don't have to bring that out unless you don't have to bring money to the closing unless you're doing a purchase, a reverse mortgage purchase. Then you're going to pay for your closing costs. Okay, so that upfront mortgage cost is high. So why I'm telling you that is most people have sticker shock. Why are my closing costs so high? There are two components. The interest rate inside the reverse mortgage, the interest rate, okay, is negotiable, and the origination fee, okay, is negotiable. Okay, that program, they'll fluctuate depending on your lender and your loan originator. So ask them if that is negotiable. That's a negotiable component on it. Okay, it may affect the money you get out of your reverse mortgage. Okay, remember, the loan originator needs to get paid, the lender needs to get paid. So they're going to charge you something in there. You're going to have an effect on it, or they're just not going to do it for you. But you can negotiate those things in most cases. Okay, so understand that. So with that in mind, okay, and I keep dropping my towel here, so I want to take that out. Some things to consider with a reverse mortgage. This is my opinion and my self rules that I work with when I work with people. If you think you're going to sell that home in less than 5 years, okay, you're going to sell or refinance that home within 5 years, do not do the reverse mortgage unless it's absolutely necessary. The cost to do that loan is very expensive, so you're getting a very expensive loan, okay, with the reverse mortgage. So make sure that the reverse mortgage, I really like to see it be people's final home, their retirement home. Okay, that's the goal of it, is to use it for retirement. It's not to be used, hey, we just want to go here for a couple of years, see how we like the neighborhood. That's a very costly loan. You don't want to get in. It's too expensive. But if it's going to be your last home, your lifelong home afterwards, you're going to be there 10, 15, 20 years, you know, till you're in your 90s or beyond. A lot of people are pushing 100 years old and their retirement is set and fixed, so it's not reaching them. So that's what reverse mortgage is really good for. That's what you want to do, a reverse mortgage, but you do not want to do it if it's less than 5 years. Less than 5 years is really bad, okay? There's exceptions to it. More than 5 years, it can be very good, okay? More than 5 years is good, okay? And that's my opinion on it. Okay, you need to recoup those costs and the benefits of a reverse mortgage, and it's better exercise beyond 5 years, okay? So I just want to give you the basics. Use it, talk to your loan originator, talk to someone who's really good with reverse mortgages. This can be a great benefit for so many of our seniors, and it can really help with your retirement plan and put you in a decent home to live on. It's better than renting when you're retired.